Passive stock investing is based on the notion that you place your money in a broad-based index or a group of stocks, either through an index fund or exchange-traded fund, an ETF. The idea is that if you buy the entire market, then you should be able to get the same return as the market as a whole. In theory, you should be able to realize a return on your investment that just lags the market by only the cost of the transaction fees that you incur in having your money parked in the fund. The concept seems simple enough to put into place. You just buy a large basket of stocks passively through the fund and hold on to it until you are ready to cash out. Unfortunately, although simple to implement, passive investing has proven to be very challenging from a psychological perspective to follow. Most investors are unable to buy it and forget it. According to a recent research study by Dalbar, the average holding period for all equity mutual funds is 3.2 years. If you are a typical passive investor, then flipping from one fund to another or moving in and out of the market every 3 years is going to have a dramatic effect on your bottom line. This shows up in another recent study by Dalbar, that in the 20-year period ending in 2009, equity mutual fund investors only received annualized returns of 3.2%. However, over the same time period, the S&P 500 had annualized returns of 8.2%. That's a whopping 5% difference. So if passive investing is touted by many financial experts as an easy approach to wealth building, why do so few investors succeed in using this strategy? The simple answer is that psychologically we are not hardwired to take the emotional component of investing out of the equation. We tend to be our worst enemies by getting caught up in the emotional hype surrounding the stock market. We bail when it looks like the entire financial system is going to collapse, only to realize later that we should have held on to catch the big gains after a market correction. Or we chase after the latest and hottest industry or sector in the hopes of catching some big gains. Having the discipline to stay the course is not easy. Being a passive investor is not easy. It is a true testament to one's strength of character to be able to take the emotion out of investing and base one's decisions on sound rational reasoning. Passive investing may appear to be easy at first glance. However, most passive investors fall victim to a lack of emotional control that costs them dearly over time. Should you hear a financial advisor or stock investment guru tell you that passive investing is easy, think again about what the actual historical returns are for the majority of passive stock investors. Maybe there's an alternative approach worth considering. Join us today at Stock Investing Simplified and find out how you can become a better investor. To your ongoing success as an investor,